You know, when we think about the financial system, our minds usually jump straight to the stock market. But today, we're going to pull back the curtain on the one force that quietly shapes everything. From your car loan to your insurance premium, it's something much, much more fundamental.
And this quote, it just nails it. We get so caught up watching the daily swings of the market, but that's often just a symptom. The real story, the root cause of so many financial shifts, actually starts with the price of money itself.
So, here's our game plan. First, we're going to pinpoint the real center of gravity in finance. Then we'll break down the single most important tool they use. After that, we'll trace how that one tool sends ripples through the entire economy. And finally, we'll step back and look at the big picture, why the system is designed the way it is.
Okay, so at the absolute heart of this whole system are central banks, like the U.S. Federal Reserve, and their influence goes way beyond Wall Street. They essentially set the base cost of money for the entire global economy, and that affects financial decisions that you and I make every single day. So what is this incredibly powerful tool they have? It's a concept that sounds almost ridiculously simple on the surface, but believe me, its consequences are absolutely massive. Let's dive right into the core of it.
At the end of the day, an interest rate is just this. It's the price of money. That's it. Just like there's a price for a cup of coffee or a new phone, there is a cost to borrowing money. And that cost is the interest rate.
Right, so think of interest rates as a kind of gas pedal for the whole economy. When rates are low, money is cheap. That encourages all of us, people, companies, to borrow and spend, and it really fuels economic activity. But when rates go up, money gets expensive. That naturally cools things down. Central banks are constantly, carefully adjusting this pedal to try and keep the economy running smoothly.
So, how does this price of money actually make its way into your wallet? Let's trace the journey, starting with something pretty much all of us have and use, a credit card. The very first, most direct ripple hits the world of credit. This is really where a big decision made by a handful of people in a central bank starts to personally affect you and me.
Now, you have to understand, this isn't like flipping a light switch. It's a slow, quiet chain reaction. First, the central bank adjusts the main rate. That makes loans more expensive for the big commercial banks. Then, those banks start to get a little more picky about who they lend money to. And the end result? The overall growth of credit in the economy starts to slow down. It's a very deliberate reshaping of behavior.
Okay, let's jump to an industry that seems totally separate but is, in fact, deeply connected to all this: insurance. I mean, you probably don't think about the Federal Reserve when you pay your car insurance bill, but maybe you should.
So here's the crucial link. Insurance companies take the premiums we all pay every month and they invest that money, usually in super safe things like government bonds. Well, the money they make on those bonds is tied directly to interest rates. So when rates move, the insurance company's entire financial model has to change, and that ultimately trickles down to the price you pay for your policy.
And now for our last example, one that many people once believed was totally outside of this whole traditional system. Let's talk about how Bitcoin and other digital assets fit into the picture now.
For the longest time, Bitcoin was seen as this fringe asset, completely disconnected from mainstream finance. Well, that's just not the case anymore. Today, its price often moves in response to the very same things that affect stocks and bonds, including changes in interest rates. As more and more traditional money has flowed into the space, Bitcoin has become linked to the very system it was once meant to be an alternative to.
Okay, so we've connected the dots, from a central bank's decision all the way to credit, insurance, and even crypto. So let's pull the camera back and ask, what does this tell us about the way our financial world is actually built?
When you really look at how slowly and deliberately these ripples move through the economy, the core design principle becomes crystal clear. Our entire financial system is built for stability, not for speed. The goal isn't rapid, unpredictable change. It's to create an environment that is as methodical and as predictable as possible.
So we've seen how these three very different parts of our financial lives, credit, insurance, and Bitcoin, are all tethered back to that one central force. Each one is a universe in itself. So the question we want to leave you with is, which one of these connections do you want us to explore next? Let us know.